Hi, I'm Pat LaPointe from Frontier Angels, and I'm here today to share a perspective on a really important question of, can you still raise money in a pandemic for your growth company? And can you still do it in Montana at that? I'd like to share with you a couple of thoughts, a little bit of a presentation on the topic. So, a lot of times what I get from entrepreneurs is a question about, how do I keep my company really growing during the course of this pandemic economy, and what options do I have available to me? Well, the answer to our two questions here of, can you still raise money in a pandemic, and can you still do it here in Montana? The answers are definitively yes and yes. Now, investors are still investing. In fact, I saw some data recently from the Angel Capital Association that did a survey of angel group leaders like myself across the United States. Over 300 groups responded, and over 90% of the groups said that they were investing more money in 2020 than they had in the previous 3 years. I also saw some data that suggested that they're doing more deals as well. And so, in general, the access to capital is wide open. There's still a lot of investors who are looking for really good quality early stage opportunities. There is also a substantial amount of money available here in Montana. In fact, almost every year we have a little bit of an excess of available capital in Montana relative to what we'd like to be able to invest in the state of Montana. And so we need to continue to work together as a community to try to make sure that we're able to put all of that available investment capital to work behind some really good options. Now, there are a couple of caveats here. The first caveat is that scrutiny levels are in fact a bit tighter. It's shifted to become a little bit more of a buyer's market than a seller's market. In other words, investors have a little bit more influence in the process right now, given some of the economic uncertainty. So all that really means is that the scrutiny levels are a little higher, and therefore you have to be a little bit tougher. You have to be much more clear about what you think you're going to need in the way of investment capital and where you think you're going to find it. Be very focused on this question. Second, you have to have a razor sharp pitch, sharper than you've ever imagined having before, because there are a lot of companies that are pitching, not just for the first time, but there's a lot of companies who are running a little short of cash that are pitching for a second, third, or fourth fundraise. And so there's an awful lot of presenting going on and a lot for investors to absorb these days. Your razor sharp pitch is what it's going to take to really cut through the clutter. And third, the deal has to have financial appeal. I said it's a little bit of a seller's market. It's not a dramatic shift from a seller's market to a buyer's market. It's now a little bit more in favor of buyers, but more importantly than ever in times of financial uncertainty, making sure that your presentation has a strong level of financial appeal to the prospective investor is really crucial. So let's walk through each one of these three things in turn and dive a little bit deeper. Now, what do you need? Where are you going to find it? Well, there are really 2 points here that we have to touch on. First is focus on the milestones that you think you're going to achieve with investment capital, not just on how you're going to spend it or the activities that you're going to undertake. Think about value creating milestones. The second is make sure you're looking for money in the right places. There are multiple different places to go looking for money, and your ability to find the ones that are more likely to say yes is going to make you much more efficient and allow you to focus a whole lot more of your time and attention on making your business work rather than be out constantly on the fundraising trip. Now, when we talk about milestones of value, let's imagine a scenario in which there's a chart with valuation increasing on the left-hand side, valuation of your business over the course of time on the horizontal axis. And let's imagine further that there's a path of milestones that will take place over the course of your business life stage, represented here by M2, M3, M4, etc. Now, it isn't often a straight line. It's usually kind of wavy, and there may be some milestones that are important that you have to pass through, like technical proof points or successful prototypes with customers or things of that nature. And there are other milestones that represent a really big jump up in value. So for example, milestones 2 and 3 might be critically important for you to pass through on your way to milestone 4, where you wind up seeing a big jump in value because now all of a sudden your company has sort of de-risked itself materially and shown that it has a higher probability of success over time. Same is true when you look at milestone 5, might be a little bit more of a milestone you have to pass through, but milestone 6, again, is where you might expect to see a big jump up in value. Now, where this becomes relevant is in terms of where you think about raising money in your life stage. These are the places where you want to raise money. You raise money at the beginning with your eyes on getting to the next big inflection point. And then you raise money at that inflection point, and you raise enough money at each inflection point in order to get you to the next inflection point on the chain, not the next milestone necessarily, the next value inflection point. So you raise enough at M1 or M2 in order to get to M4. And then if you have to raise again before M4, you're going to find that you get yourself diluted. So you want to make sure that you're raising enough to get up to that next level. And then at M4, you want to raise enough money in order to get to M6, and so on and so on. So when we talk about when to raise money, this is what we're talking about. And when we talk about focusing the conversation around milestones of value inflection, this is what investors really want to talk about, not necessarily that you're going to spend X amount of money on sales and marketing or Y amount of money on building a new piece of equipment. Those things are relevant to the conversation, but the more important things are, what are the milestones you're going to achieve? Now, the next key point is looking for money in the right places. So as you think about the evolution of a business over the course of its life cycle, from the idea stage to an actual innovation to maybe a prototype, and then a launch in the marketplace, followed by a period of hopefully rapid growth, and then maybe a little bit of maturity as the business gets bigger and bigger. We can look at the profit scale on the left across that different life stage of the business, with profits being neutral in the middle and negative, and then positive at the top. And so maybe what we're looking at is a curve that looks something like this, where you start out neutral, but then you're investing money in the business through the innovation and prototype and even in the launch stages. And maybe somewhere around the prototype stage, you actually start to have some revenue coming in, which is great. Now, if this is the way the business flows, it's really important to understand that there are different financing options at different stages of where you are in this evolution. In the idea and the innovation stage, most of the money you're likely to raise is going to come from either friends and family, or from grant funding from NSF or SBIR or DoD types of grants, or maybe from crowdfunding, very sort of creative, often non-dilutive types of funding sources are what's going to get you off the ground through those very early stages. Once you start to have some sort of a prototype evidence that something's really possible, some evidence that maybe there's an opportunity in the marketplace for what you're building, that's where angel investors usually tend to get involved. Right where the cash flow is really flowing out the door substantially, where the losses tend to be greatest, is usually where angels get involved. And the angels' goal is to create a bridge to the launch and the growth stages. And so when you get into the launch and the growth stages, that's where you often need even more money in order to be able to invest in sales and marketing and scaling up your product capacity or whatever the case may be. And that's where venture capitalists usually come into play. And venture capitalists then provide the bridge to getting to a point where you've got steady, reliable cash flow. And then the banks are going to be interested in financing your business from there on out. So it's really important to understand that there are different places to go looking for money depending upon where you really are in the life stage of your business. So Being focused on your milestones and knowing where to look for money is the first part of being successful in raising money in a pandemic environment. Now, I mentioned that you also have to have a razor sharp pitch, not just because you always have to have a razor sharp pitch, but because right now investors are seeing a lot of their existing portfolio companies come back around looking for more money because maybe they got a little bit short in the pandemic and need to get shored up to make sure that they can survive. So the pitch flow going on, even in my world, in the angel world, is pretty significantly higher than it was a year ago or 2 years ago, just in terms of the number of already quality presentations that I have to look at on a week-to-week or month-to-month basis. Now, what goes into a sharp pitch? Well, first and foremost, be really clear about what problem you're solving in the world. Why does the world care about what it is that you're doing? How big a problem or an opportunity is it? Are we talking about something where there's millions of dollars of opportunity, or tens of millions, or hundreds of millions, or better yet, billions of dollars of potential opportunity? We need to see that you've done some homework to figure out just how big a problem this is. How are you solving for that problem? Don't assume that investors are going to understand how what you're doing actually solves or resolves the problem or seizes the opportunity. You're going to have to make sure that it's really clear, whether it's a technical innovation or whether it's a business model innovation or whatever the case may be, that it's understandable to general lay people without your technical expertise how your solution actually solves the problem. How do you know it works? How have you mitigated some of the technical risks? What kind of bench studies have you done, or what types of software tests have you done in order to prove that what you think will solve the problem can actually even be built and ultimately even be deployed to a customer? And speaking of customers, what evidence do you have that customers are going to want to buy it? Now, if you're a consumer app building apps for a mobile phone, usually investors want to see that you've really got an app up and running and on the marketplace and have a couple of people using it and maybe some people paying for it. But if you're building a medical device or you're building some form of a real technical innovation where going to market is something that'll happen after years of further R&D and exploration work, well then what we're looking for is some research or some first-hand data that customers say, yes, this is going to solve a big problem for me and I'm willing to wait for it to be ready and then I'll be willing to buy it. What's your true competitive advantage? So especially if it's going to take you a while to get to a point where you have a lot of customers and a big revenue flow and a big business, you're going to need a buffer, or sometimes people call it a moat, like a moat around a castle. You're going to need time before the competitors start chipping away at you and going after the same prospects and maybe doing stupid things like undercutting your pricing. So what is your competitive advantage that's going to make it really hard for people to copy you quickly so that you have time to get seeded in the market with your prospective customer base? How are you going to deploy and support your solution? Once you've actually got it and you've got customers willing to pay for it, explain to us how you're going to make sure that the product or the solution actually gets used in the market, and how are customers going to be able to find the support that they need to be successful with it and therefore happy with it. How are you going to find those customers? How are you going to close deals? It's often not hard to find the first handful of customers. And then finding the next 10 or so is usually a little bit harder, but not that difficult. It really gets difficult when you need to find that next 100 or the next 1,000 or the next 10,000 customers. So what are your thoughts about how and where you're going to find those customers? Who on the team brings what capabilities? Who's got the expertise that's going to make this thing happen? Who's got the skills and the capabilities and the perspective that we, the investors, don't have, that's going to really be driving the vision and figure out all the many little tough problems that are going to pop up along the way? How much money do you need to get to your milestones? We talked about that, critical part of a sharp pitch. And then how will an investor actually get their money back? So every investor is willing to look at the prospect of investing, but only with the promise that at some point the money is going to be able to come back home. Because if the money doesn't come back home, it's not very good for us. So the investor wants to hear your vision of whether you're going to maybe get bought by another company, or you're going to go public with your company, or you're going to raise a larger round and buy out your investors, or you're going to use cash flow to buy out your investors. Any of those things are fine, but we like to hear what your perspective is around these things. So if you want to dive deeper into what constitutes a sharp pitch, there's a couple of really good videos online at frontierangels.com, and a couple of lists of the kinds of questions that investors very frequently ask before they'll consider investing in your business. I recommend you go have a look at that. Next is to build financial appeal. Everybody loves a great deal, but when I talk about financial appeal, what I'm really talking about are three things. The first is an attractive implied return potential, meaning that the investor can see the opportunity to earn at least the minimum threshold of return that they're after. And in many cases, that minimum threshold return is 2, 3, 4 times their investment over the course of a 3, 4, 5-year horizon. Especially if you're an early stage technology company, understand that it's not like the stock market where we're happy earning a 15% return each year. That's wonderful. See, the difference is that the stock market has liquidity, and there's a lot of people looking under the covers for each of the stocks that might be sold in a stock market. The risks are much, much higher when we're investing in early stage companies like yours. And so investors are looking for at least a 3, 4, 5x return. A lot of times investors are looking for an 8, 10, 12x return in order to make their overall portfolio work. Make sure that you understand what the investor expectations are, and that you feel like you've got a really viable way of helping the investor achieve that, and then be able to articulate it to them effectively. A reasonably priced deal is also really important. And by reasonably priced, what I mean is that you're asking for money on terms and at a valuation that are not completely out in space. Now, how do you know if you're asking for terms or valuation that are completely out in space? Well, first and foremost, you can talk to an attorney who's got a lot of experience with early stage securities law. Look for attorneys who do dozens, if not hundreds, of these kinds of deals every year. And so they have a real good sense of what terms are very common in the current marketplace, and what you'll need to do to structure your deal. From a valuation perspective, my suggestion is that you look at external sources. Look for other companies that in some material way are like yours, where there may be some benchmarks in Crunchbase or in PitchBook or in any number of other places online. And it's not often easy to find those kinds of specific valuation benchmarks, but if you look around enough, you can often begin to triangulate on what's working. I would also encourage you to just schedule informal conversations with angel groups or venture capitalists and talk a little bit about valuation, and talk about ranges of where they think might be reasonable, and where you think might be reasonable, and what kinds of evidence or suggestions or arguments you might have for a higher valuation that you'd like for your business. In the end, investors are reasonable people. We really just need to see reasonable arguments presented in order to feel comfortable that when we're buying shares in a company, that we're buying them at a fair price. And then finally, how do you account for the financial uncertainty of the existing pandemic environment? We have no idea how much longer this is going to last. I mean, we generally think that there'll be a vaccine, and that the vaccine may be available to us in a couple more months. But how long is it going to take before the population in general is vaccinated enough that things are starting to return to normal? What kind of effect do you think it's going to have on your business in the interim? What kind of effect will it have on the people who might be buying your product? What kind of effect would it have on the people who might be developing your product with you, on your ability to hire people, et cetera, et cetera? So know that it's a big risk factor in the minds of investors right now, and be prepared to show us how thoughtful you are with respect to what impacts you expect to continue to see for what period of time, what your contingency plans are, et cetera. The last thing either of us want is a situation where the current macroeconomic forces wind up creating an environment that lingers longer than we expected. And As a result, you find yourself running out of money. That's clearly not good for anybody. So the good news is here in Montana, there are a lot of organizations who are able to help you think through and work through a lot of these things, whether it's 406 Labs at MSU or Missoula Economic Partnership, or the Blackstone launch pads at MSU or University of Montana. Us here at Frontier Angels, the Early Stage Montana program is a great place to go looking for some free mentorship help. Montech out in Missoula, Next Frontier Capital, the venture fund, Big Sky Economic Development, and the Rock 31 program out in Billings. The SBDC offices across the state of Montana are always eager to help if they can. The High Tech Business Alliance is a great place to network with other entrepreneurs like yourself who might be able to point you in some good directions. And then Prospera Business Network in the Gallatin Valley also has some really good educational programs for entrepreneurs. So there's tons of people across the state of Montana who are willing to help you think through and get prepared to raise money and keep your company growing and thriving, even in a pandemic environment. So with that, I'd just like to say thank you, and I'd love to hear from you. Please feel free to shoot me an email, ask me questions, go online to our website, take a look at some of the resources that we have available to you. And I hope you enjoyed the presentation, and congratulations on getting your business off the ground. Thanks.